Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. We're going to talk about wealth management, asset allocation, and I think it's critically important right now. So I think I'm getting smarter as the years go by and the market's just completely getting stupider. I look back to 1987, 1999, and I see very similar things occurring. So in 1987, I was a young pup in the business, and we used a dividend discount model of sorts to do our asset allocation. My boss is a smart guy, and he took our accounts to a very conservative level back then. He took the equities down as far as he can get them. He could get the equity allocation to, and that was in February. If you remember 1987 at all, the market ran until October, actually until about August. It kind of peaked out in July, and then really capitulated in October. So similar things happened in 99 and 2000, that the valuations between equities and fixed income got completely out of line. There was a recession that occurred, and equities collapsed in a big way. Right now, what we're seeing is that the PE of the market at 20 times earnings is into the bubble territory. Bubble meaning it's similar to the valuations of 2000, where they got to as high as 24 times earnings. Now we're at over 20 times earnings. And obviously we've talked about this quite a bit. And we all know this, that the valuations of the markets are being distorted by the mega cap tech stocks, but it is still the valuations of the overall market, and you need to adjust your allocations appropriately given your level of risk. First, we want to talk about what happened in the markets last week. Generally, we don't review what happens in the markets on a weekly basis, but I think it's important to go back and review this so you understand really what's happening inside the market itself. So on Wednesday, the Federal Reserve came out and they made it very clear they're not cutting rates in March, and the 6 interest rate increases likely not going to happen. And they still have to watch the data to make sure that the inflation doesn't come back. Okay, the market didn't like that signal. The market fell off roughly 1.6% on Wednesday. We thought this would happen, that it came back on Thursday somewhat, and you can see that red line there. That's where it came back to on Thursday. Big downdraft on Wednesday, came back on Thursday in anticipation of Meta's earnings and Amazon. And Meta had a good quarter, and must have been some short covering as well in that stock, up 20% in a day. That's what drove the market up. So you have the market understanding now the macro view of everything, but it's not willing to give up on the micro view of individual mega cap tech stocks still performing. So that's a big signal. So before the market actually comes down in a big way, those stocks will have to tire out and start to roll over. The employment report on Friday was interesting. We think it was flawed with a lot of bad data to it. There's seasonal adjustments in January, really probably offset a lot of the underlying weakness in the overall labor market. But we think that the economy is probably okay for now. But as long as the Fed keeps rates where they are, the probability of a recession occurring this year goes up. So the mega cap tech stocks, so the theme of last week was real clear that AI is driving the trends. So AMD reported, like we anticipated, there's not a whole lot to get too excited there. They did bump their guidance quite a bit for their artificial intelligence chips. So that kind of confirms the overall strength in the overall market, but that stock has a valuation issue. Microsoft's cloud computing up 28%. They said 6% of that was driven by AI. So they had a good quarter. Nothing spectacular, but a good quarter, very consistent, a good Microsoft quarter. Google up 26% for their cloud business, so a good quarter. Both Microsoft and Google are much smaller than the Amazon's cloud business. They were up 13%. We played Amazon into the quarter. The quarter was good, not as good as what we would expected them to have. So, being an expensive stock, we thought with the rise in the stock price on the day they reported, we thought, okay, this is time to get out of it. So we sold our Amazon. Apple was ugly as expected. Revenues up only 2%. China down 13%. So not great there either. They really need to find a way to reinvigorate their revenue growth. But that services business only growing about 11% in that range. But that's not enough to get that stock going. Meta. Now, to understand Meta, you have to look at how much they surprised on the revenue, which is 2%. The earnings was a surprise by 10, so they have some nice leverage there. The message given by last week was that artificial intelligence is here. It's probably not accelerating. There's huge capital expenditures being put in place. It is somewhat economically sensitive because their customers need the cash flow to deploy these new technologies. And we see it more as a expense savings rather than a significant improvement in revenues for a lot of companies. But overall trends are good. The market's on it. The market loves the idea, and it's not giving up on it yet. Wealth management. So we think that wealth management, obviously, or asset allocation, is critically important for returns over time and critically important to make adjustments when adjustments are needed. So if you look at the valuations of the equity markets currently, so as I mentioned, the PE to multiple of the stock market of the S&P 500 is over 20 times currently. If you take the earnings of the S&P, this is 242 in earnings for this year, projected. 242 divided by the price of the S&P gives you about 4.9% earnings yield. Obviously different than dividend yield. 4.9% earnings yield. That way you can compare it to other asset classes. So if you compare it with the 10-year Treasury of 4.1%, obviously it is above the 10-year Treasury, but generally there's a bigger spread. So only a 80 basis point spread between the two, that's historically unattractive. So typically what we like to see is about a 1.6% spread or more to make the equity markets more interesting than the bond markets. Now the asset class that really stands out is the cash or shorter term treasuries at roughly 5.4%. That's a gift. When you compare all three, we like the cash followed by shorter term bonds. You don't need to go out long, but shorter term bonds, and then different asset classes within the overall equity markets. But the problem is it's too early yet to buy the value, cyclical stocks, small cap stocks, mid cap stocks, except for trades. So we're stuck in a market that's not set up very well. So the best thing to do is to bring down your overall allocations to a more conservative level. If you're an 80% stock person and 20% fixed income or cash, then you might want to bring that down to maybe 50% when it's appropriate. We think it's becoming appropriate currently. So bring your asset allocation down to a more reasonable level as the risk of the markets are high. We do think that the real risk to all this is that the Federal Reserve may put the economy into the ditch, meaning they may stay tight for too long, which is okay. The only way you're going to kill inflation is with a recession. It's not going to happen with this soft landing BS that they've been talking about. So If they just have a soft landing or no landing at all, this inflation risk is going to stay out there and it's going to come back to bite the overall market over and over again. So our message is, if you like the mega cap tech stocks, and at times some look really compelling, fine, stay in them, play it, but use a stop loss. Your overall equity exposure can be shrunk down some. You're not going to give up a major return this year. It's just not going to happen. So equities are not going to go up in a big way with PE multiples now above 20 times, unless the Federal Reserve really starts to cut rates very aggressively and we do not go into recession, which we don't think that's really a high probability of occurring. So asset allocation, a important thing to be considering. Your wealth is important. So look to reduce your equity exposure, be more defensive. Remember that this could last another 6 months before it ultimately rolls over. Thank you very much. Please hit like. Come to my website, Patrick Adams CFA. Sign up for Market in a Minute. Get a hard copy every week where we go into a lot more detail. Take care.